The most successful trades of all time. The top 6 trades. There have been numerous successful trades throughout history, but some stand out above the rest. Here are 6 of the most successful trades of all time. John Paulson's bet against the housing market in 2007. In 2007, hedge fund manager John Paulson made a bet that the housing market was overvalued and would soon collapse. He bought credit default swaps, CDS, on mortgage-backed securities, essentially betting that the value of the underlying mortgages would decline. When the housing market did indeed collapse, Paulson's bet paid off big time. He made $15 billion in profits in 2007 alone, making it one of the most successful trades in history. George Soros bet against the British pound in 1992. In 1992, George Soros, another hedge fund manager, made a bet against the British pound. He believed that the pound was overvalued and that the Bank of England would not be able to keep it artificially propped up. Soros bet against the pound by selling it short, and when the Bank of England eventually abandoned its efforts to support the currency, the pound plummeted in value. Soros made a profit of $1 billion on this trade, earning him the nickname, the man who broke the Bank of England. Paul Tudor Jones bet on the stock market crash of 1987. In 1987, Paul Tudor Jones, a hedge fund manager, correctly predicted that the stock market was about to crash. He bet against the market by buying put options, which allow the holder to sell a stock at a certain price, even if the market value has fallen. When the stock market crashed on October 19, 1987, now known as Black Monday, Jones made a profit of over $100 million. Ray Dalio's bet on Treasury bonds in 1981. In 1981, Ray Dalio, the founder of Bridgewater Associates, made a bet that the Federal Reserve would lower interest rates in order to stimulate the economy. He believed that this would cause the value of Treasury bonds to rise, and he was right. Dalio's bet on Treasury bonds paid off handsomely, making him a fortune. Andrew Hall's bet on crude oil in 2003. In 2003, Andrew Hall, a trader at Citigroup, made a bet that the price of crude oil would rise. He purchased a large number of crude oil futures contracts, betting that the price would increase. His bet paid off when the price of oil skyrocketed in the wake of the Iraq War and Hurricane Katrina. Hall made a profit of over $100 million on this trade. Kyle Bass bet against subprime mortgages in 2007. In 2007, hedge fund manager Kyle Bass made a bet that the subprime mortgage market was about to collapse. He purchased credit default swaps, CDS, on subprime mortgage-backed securities, betting that the value of the underlying mortgages would decline. When the housing market did indeed collapse, Bass bet paid off handsomely. He made a profit of over $500 million on this trade. These are just a few examples of the most successful trades in history. While the individuals who made these trades were certainly skilled and had a good understanding of the markets, it's important to remember that successful trading also involves a good deal of luck. No one can predict the future with complete accuracy, and even the most successful traders can have their share of losses. However, it's also important to note that these successful trades were not made in a vacuum. They all occurred within a broader economic and market context, and the traders who made these bets were able to identify and take advantage of opportunities that were created by these larger forces. For example, John Paulson's bet against the housing market was made possible by the fact that the housing market was in the midst of a bubble, with prices reaching unsustainable levels. George Soros' bet against the British pound was made possible by the fact that the pound was overvalued and the Bank of England was unable to maintain its value. Paul Tudor Jones' bet on the stock market crash of 1987 was made possible by the fact that the market was overvalued and due for a correction. Ray Dalio's bet on Treasury bonds was made possible by the fact that the Federal Reserve was likely to lower interest rates in order to stimulate the economy. Andrew Hall's bet on crude oil was made possible by the fact that the Iraq War and Hurricane Katrina were likely to disrupt the supply of oil. Kyle Bass' bet against subprime mortgages was made possible by the fact that the subprime mortgage market was fueled by risky lending practices and was due for a collapse. In each of these cases, the traders who made these bets were able to identify and take advantage of opportunities that were created by larger economic and market forces. This required not only a deep understanding of the markets, but also the ability to think critically and make informed decisions based on incomplete information. While these trades were certainly successful, it's important to note that they are not necessarily representative of the broader market or the average trader's experience. Trading can be a risky business, and it's important for individuals to carefully consider their own financial goals and risk tolerance before making any investments. Despite the inherent risks of trading, it's clear that there have been numerous successful trades throughout history. These trades demonstrate the potential rewards that can be achieved through careful analysis, risk management, and a bit of luck. Thanks for watching, like and subscribe, see you on the next one.